You opened Polymarket because you saw a market that looked obvious. The odds were sitting at 80%, but you knew it was really 95%. You knew. You'd been following this story for weeks. You'd read the news, watched the videos, talked about it with friends, and here was a market giving you free money, so you bet $200. Then $400, then $1,000, and then you lost. And the worst part wasn't losing the money. It was the realization that you didn't actually know what you thought you knew. If this story sounds at all familiar, this video is for you, because the rise of prediction markets like Polymarket and Kalshi has revealed something uncomfortable about smart, informed people. Most of them are losing money, and the reasons why have less to do with the markets, and more to do with how your brain handles being wrong. Let's start with the numbers, because they are wild. In a 2026 study analyzing 1.72 million Polymarket accounts and $13 billion in trading volume, researchers found that only 3% of traders consistently make money. More than 2/3 of users are in the red, and get this, only 0.015% achieve consistent profits at a level that might let them quit their job. That's about 1 in 6 500 traders, so if you've ever bet on Polymarket and felt like you should be doing better, statistically you're not the exception. You're the rule, so why do smart people keep losing on these platforms? There are 4 psychological reasons, and they're going to feel uncomfortably specific. Reason 1. Overconfidence in your own predictions. Research dating back decades shows that when people say they're 90% sure of something, they're actually right about 70 to 80% of the time. That gap between how confident you feel and how accurate you actually are is called the overconfidence gap. And in prediction markets, this gap costs you real money. When something looks like it should happen 90% of the time, the market often prices it correctly. You're not finding free money. You're finding events that feel obvious to you, but that the market has already priced in. The market doesn't reward you for noticing what everyone already noticed. Reason 2. The illusion of skill. Here's what happens to a lot of people on these platforms. They place a small bet, they win, they place another, they win again. After 2 or 3 wins, your brain has constructed a story. You have a feel for this, you're good at it. You see things others don't. This story is almost always wrong. Researchers ran simulations on every Polymarket trader, replaying their bets 10,000 times with random direction, and they found something brutal. 60% of people who looked like winners were actually just lucky. When tested on a new sample of events, they turned into losers. Their early wins weren't skill. They were noise, but once your brain has decided you have skill, it will keep telling you that, even when the evidence stops supporting it. Reason 3. Loss chasing. Behavioral economics has known this for decades. The pain of losing money is psychologically about twice as strong as the pleasure of winning the same amount, so when you lose, your brain does not say, oh well, that was the cost of speculation. Your brain says, you need to make that back right now, and so you place another bet, often a bigger one, to recover. This is the same psychological mechanism that drives gambling addiction. Prediction markets are not gambling. But your brain doesn't know the difference. It feels the same. It rewards the same neural pathways, and it triggers the same loss-chasing spirals. Reason 4. Narrative bias. This one is the most subtle, and in some ways the most dangerous. When you have a story in your head about why something will happen, you stop seeing the evidence that contradicts that story. This is called confirmation bias, and it is everywhere on prediction markets, because every market has an obvious narrative attached to it. This candidate will win because of the polls. This company will succeed because the founder is brilliant. This event will happen because it just feels inevitable. And the more compelling the narrative feels, the more your brain will overweight it. This is why prediction markets consistently overestimate dramatic, low-probability events. Researchers have found that more than 73% of prediction market outcomes resolve as no. In other words, the average bettor is consistently overestimating how likely unusual things are, and the ones who actually profit on these platforms tend to do something boring. They systematically bet against the dramatic narratives. Vitalik Buterin, the co-founder of Ethereum, reported earning $70,000 on Polymarket, specifically by targeting markets where the crowd looked irrational. His strategy was almost the opposite of what most people do. Bet against the obvious story. Bet against the exciting outcome. Bet against the thing that feels right. This is brutally hard to do, because every part of your brain will fight you. It feels wrong to bet against your own analysis. It feels wrong to admit the crowd might be more wrong than you are. It feels wrong to take the boring side, but that is exactly why the boring side often pays. Now here's the deeper question this video is really about. If most people lose money on prediction markets, why do they keep trading on them? And the honest answer is, they're not really trading. They're entertaining themselves. They're getting a small dopamine hit every time they engage with their predictions. They're feeling smart, even when they're losing, and they're paying for that feeling with real money. There's nothing inherently wrong with this, by the way, if you treat prediction markets the way you treat going to a concert or buying a video game. Pay for the entertainment, enjoy the experience, expect to come out a little behind. That's a perfectly fine relationship to have with these platforms. The problem is, most people don't think of it that way. They think they're making smart investments. They think they're going to extract value from inefficiencies in the market, and then they wonder why their account keeps shrinking. So what should you actually do if you've been losing on prediction markets? 3 things that genuinely help. First, separate the entertainment budget from the investing budget. If you want to use Polymarket the way someone might use a casino, that's fine, but that money should come out of your discretionary fund budget, not your savings. Decide on an amount you're willing to lose entirely, not 90% lose, 100% lose, and don't go above it. Second, write down your prediction before you check the market price. This single habit fixes more bias than anything else. If your prediction is 70% and the market is at 80%, that's information. It tells you the market knows something you don't, or the market is overconfident. Either way, the fact that you wrote down 70% before looking is what gives you the edge. Without that step, you're just rationalizing whatever the market shows you. Third, track your actual results over a long period. Not your wins, not your best bets, all your bets. Most people who claim to be good at prediction markets have selectively forgotten the losses. They remember the time they predicted the election. They forget the 5 times they lost on the sports bets. If you actually track everything, the picture becomes clear pretty quickly. You'll see whether you have an edge or whether you've just been telling yourself a story. Here's what I want you to take away from this video. Prediction markets are not the stock market. They are a fascinating, often entertaining, sometimes informative arena, but they are not a path to wealth for the average user, and the people who think they're the exception are usually the ones funding the actual exceptions. If you've been treating Polymarket like the stock market, that doesn't make you stupid. It makes you a person whose brain is working exactly the way human brains work, and once you can see that, you can decide what kind of relationship you want to have with these platforms. Maybe it's a fun, capped, entertainment-only relationship. Maybe it's a careful, hypothesis-testing relationship where you write predictions down first. Maybe it's no relationship at all. All of those choices are valid. What's not valid is convincing yourself you're a skilled investor, when the data clearly shows that 97% of people doing what you're doing are losing money. If this video felt like someone was reading your mind, you're not alone. Hit subscribe so you don't miss the next one. Comment below. Have you ever bet on Polymarket or Kalshi? What did you actually walk away with? I read every comment, and if you want to go deeper, watch my video on people who refresh their bank account 5 times a day. Same psychology, different surface. Until then, write the prediction down first, and know what you're really paying for.